Right now, somewhere in the world, an algorithm is watching the market. But it's not just watching the price. It's watching you, your entries, your exits, your hesitation, your fear. And the uncomfortable truth is this: artificial intelligence may already know your next trade before you do. Most traders believe they are competing against the market, supply and demand, buyers and sellers, bull versus bear. But that picture is outdated, because in modern markets, the real opponent is something else. Algorithms, machines, artificial intelligence, systems that analyze millions of patterns every second, systems that never panic, never hesitate, never second guess. And if you trade like most retail traders, those systems can predict exactly what you will do next. Every trader believes they are making independent decisions. They think their strategy is unique. Their entries are special. Their analysis is different. But when millions of traders behave in similar ways, their actions become predictable. Think about this. Thousands of traders place stop losses at obvious levels. Thousands enter trades after the same breakout. Thousands panic during the same market drop. To a human, this looks chaotic. To artificial intelligence, it looks like a pattern. Humans see charts. Algorithms see behavior. Every trade leaves data. Every entry creates information. Every stop loss reveals intention. Artificial intelligence studies these behaviors. Not one trade, not 10 trades, millions. Over time, patterns appear, not price patterns. Retail traders leave a footprint in the market. It appears in predictable places: stop losses below support, breakout entries above resistance, panic selling during sharp drops, fear during volatility, and when enough traders behave the same way, liquidity forms. Liquidity is what large players need, and algorithms know exactly where to find it. Artificial intelligence has three major advantages: speed, data, consistency. Speed allows AI to react instantly. Data allows AI to see patterns humans cannot. But consistency is the real weapon. Humans change behavior based on emotion. AI does not. AI executes the same logic every time. No hesitation, no revenge trading, no fear. Most traders believe the problem is their strategy. They keep searching for better indicators, better systems, better signals. But the real problem is behavior. Even a good strategy fails when discipline fails. Moving stop losses, overtrading, closing winners too early, holding losers too long. These behaviors repeat again and again, and repetition is exactly what algorithms exploit. Artificial intelligence does not predict the market perfectly. That is not necessary. Instead, it predicts behavior. It estimates probabilities. For example, if price drops quickly, what percentage of traders panic sell? If price breaks resistance, how many traders chase the breakout? If the market spikes suddenly, how many traders move their stop losses? These patterns are measurable, and when patterns are measurable, they become predictable. Large institutions need liquidity to execute large positions. They cannot enter trades the same way retail traders do. They need the opposite side of the trade: someone willing to buy, someone willing to sell. Retail traders often provide that liquidity, not intentionally, but through predictable behavior. When thousands of traders place stops in the same location, those stops become liquidity pools. And algorithms know exactly where they are. Every trader experiences the same moment. Price hits their stop loss, then immediately reverses. The market moves exactly in the direction they predicted. But without them, this moment feels personal. It feels like the market is targeting them. But the truth is simpler. The market is targeting liquidity, and retail traders often place their stops exactly where liquidity is concentrated. At this point, many traders ask an important question. If algorithms are this powerful, do humans still have a chance? The answer is yes, but only if traders stop behaving predictably. Because artificial intelligence does not eliminate traders. The traders who survive in modern markets think differently. They do not chase every breakout. They do not react emotionally to every candle. They do not move stop losses impulsively. Instead, they build systems. They review performance. They adapt based on data. In other words, they begin thinking like the algorithms themselves. Professional traders do not focus on individual trades. They focus on long-term probability. One trade does not matter. 10 trades do not matter. Hundreds of trades reveal the true edge. Algorithms understand this perfectly. Humans often struggle with it, because humans seek certainty. But markets operate on probability. The real edge in trading is not prediction. It is discipline, execution, risk management, the ability to follow a system even when emotions appear. Artificial intelligence is powerful, but it still relies on systems designed by humans. And the traders who understand this stop trying to outsmart the machine. Instead, they focus on mastering their own behavior. Artificial intelligence may analyze millions of trades. It may detect patterns faster than any human. It may execute orders in milliseconds. But one thing still determines success in trading: behavior. If you trade emotionally, algorithms will predict you. Algorithms will exploit you. But if you trade with structure, discipline, and patience, you stop being predictable. And the moment you stop being predictable, you stop being easy to beat. This video is for educational and informational purposes only. It does not constitute financial or investment advice. Trading involves risk, and viewers should conduct their own research before making financial decisions.